Welcome to Eagle Pocket. In this video we are going to talk about top 10 investment ideas for 2021. So before starting this video, like this video, and subscribe to Eagle Pocket for future updates. If you want to increase your income, you have two options: lower risk investments with a moderate return or higher risk investments with a higher return. When it comes to saving, there is usually a trade-off between risk and return. You can also take a more balanced approach, putting your money in completely safe investments while still allowing for long-term growth. With varying levels of risk and return, the best investments for 2021 enable you to do both. Number 1. High-yield savings accounts. On your cash balance, a high-yield online savings account earns you interest. High-yield online savings accounts are accessible platforms for your money, much like a savings account collecting pennies at your local bank. Online banks usually offer significantly higher interest rates due to lower overhead costs. Plus, you can usually get your hands on the money by converting it to your primary bank, or using an ATM. For those who may need cash in the near future, a savings account is a good option. A high-yield savings account is ideal for risk-averse investors, especially those who need funds quickly and want to avoid the risk of losing their investment. Number 2. Certificates of deposit. Banks issue certificates of deposit or CDs, which usually pay a higher interest rate than savings accounts. The maturity dates of these federally insured time deposits will vary from a few weeks to several years. Since these are time deposits, you can only take the money out after a certain amount of time has passed. The financial institution pays you interest on a CD at set intervals. When it matures, you will receive your initial principal plus any interest that has accrued. It pays to look around for the best deals online. CDs are a good option for retirees who don't need immediate income, and can lock up their money for a while because of their protection and higher payouts. However, there are a variety of CDs to suit your needs, so you can still benefit from the higher CD prices. A CD is a good choice for risk-averse investors, particularly those who need money quickly, and are willing to tie up their funds in exchange for a higher rate of return than a savings account. Number 3. Government bond funds. Government bond funds are mutual funds or exchange-traded funds that invest in debt securities issued by the government of the United States and its agencies. T-bills, T-notes, T-bonds, and mortgage-backed securities issued by government-sponsored companies, such as Fannie Mae and Freddie Mac, are among the debt instruments in which the funds invest. These government bond funds are ideal for investors who are looking for a low-risk investment. These funds are also a strong choice for new investors, and those looking for a steady stream of income. For risk-averse investors, the best investment for government bond funds can work well, but certain forms of funds such as long-term bond funds may fluctuate a lot more than short-term funds due to interest rate changes. Number 4. Short-term corporate bond funds. Corporations can raise funds by issuing bonds to investors, which can then be pooled into bond funds that hold bonds issued by dozens of different companies. The average maturity of short-term bonds is 1 to 5 years, making them less vulnerable to interest rate volatility than intermediate or long-term bonds. Investors looking for cash flow, such as retirees, or those who want to reduce their total portfolio risk, while still earning a return, should consider corporate bond funds. Short-term corporate bond funds are a decent option for risk-averse investors looking for a higher yield than government bond funds. Number 5. Municipal bond funds. Municipal bond funds hold a variety of municipal bonds, also known as MUNIS, issued by state and local governments. Earned interest is typically tax-free at the federal level and can also be tax-free at the state and local level, making it especially appealing to investors in high-tax states or brackets. Specific muni bonds, as well as mutual funds and exchange-traded funds, can be purchased. You may work with a financial advisor to determine the best investment form for you, but you may want to stick with those in your state or region for tax benefits. Municipal bond funds are ideal for new investors, because they have diversified exposure without requiring the investor to research individual bonds. They're also beneficial to cash flow buyers. Municipal bonds are a good choice for investors in high-tax states, because they allow them to escape levies while still generating income. Because of their lower yields, they may be less appealing to investors in low tax brackets or states. Number 6. S&P 500 Index Funds. An S&P 500 index fund is a decent alternative to more conventional banking products, or bonds if you want to earn higher returns, but it does come with more uncertainty. The fund is made up of about 500 of the biggest American corporations, which means it includes many of the world's most profitable businesses. Amazon and Berkshire Hathaway, for example, are two of the index's most influential members. An S&P 500 index fund, like almost every other fund, provides instant diversification by allowing you to own a piece of each of those firms. Since the fund invests in companies from all industries, it is more resilient than many other investments. Over time, the index has averaged a 10% annual return. These funds have low cost ratios, the sum the investment firm charges to run the fund, and are among the best index funds available. Since it offers strong, diversified stock market exposure, an S&P 500 index fund is an excellent choice for new investors. Any stock investor looking for a diversified investment, and willing to remain invested for at least 3 to 5 years should consider an S&P 500 index fund. Number 7. Dividend stock funds. Stocks that pay dividends will make your stock market investments a little safer. Dividends are shares of a company's earnings that can be paid out to shareholders on a regular basis, normally quarterly. With a dividend portfolio, you'll not only get a return on your investment over time, but you'll also get paid in the short term. Individual stock purchases, whether or not they pay dividends, are best suited for moderate and advanced investors. However, you can reduce the risk by purchasing a group of them in a stock fund. Dividend stock funds are a good choice for almost any type of stock investor, but they are especially good for those seeking income. These can appeal to those who need income and are willing to invest for longer periods of time. Number 8. Nasdaq 100 Index Funds. Investors who want exposure to some of the largest and best tech companies without having to select winners and losers or evaluate individual companies should consider an index fund based on the Nasdaq 100. The fund is focused on the Nasdaq's top 100 stocks, which are among the most profitable and stable in the world. Apple and Facebook are two such firms, each accounting for a significant portion of the overall index. Another notable member corporation is Microsoft. A Nasdaq 100 index fund provides instant diversification, ensuring that your portfolio is not vulnerable to a single company's loss. The best Nasdaq index funds have a low expense ratio, making them a low-cost way to buy all of the index's stocks. For stock investors seeking growth but also being able to deal with considerable uncertainty, a Nasdaq 100 index fund is a safe option. Investors should be able to commit to keeping it for 3 to 5 years at the very least. Number 9. Rental housing. If you're able to maintain your own assets, rental housing can be a great investment. And, with mortgage rates at all-time lows, now may be an excellent time to fund the purchase of a new home, but the uncertain economy could make it more difficult to manage, as tenants could be more likely to default due to unemployment. You'll need to pick the right house, fund it or buy it outright, manage it, and deal with tenants if you go this path. If you make wise purchases, you will do really well. You won't be able to buy and sell assets in the stock market with a click, or a tap on your internet-enabled smartphone, though. Worse, you may have to put up with a 3 a.m. call about a burst pipe. However, if you keep your money for a long time, pay down debt steadily, and increase your rents, you'll most likely have a strong cash flow when it's time to retire. Long-term homeowners who want to maintain their own assets, and produce consistent cash flow should consider rental housing. Number 10. Cryptocurrency. Cryptocurrency is a form of electronic-only digital currency designed to be used as a medium of exchange. It has grown in popularity over the last decade, with Bitcoin being the most widely used digital currency. Crypto has become a hot property in recent years, as investors have poured money into the asset, driving up prices and attracting even more traders. Bitcoin is the most commonly used cryptocurrency, and its price fluctuates widely, attracting a large number of traders. For example, Bitcoin soared from under $10,000 per coin at the start of 2020 to about $30,000 at the start of 2021. And, not long after, it doubled again. It is not backed by the FDIC or the money-generating power of either a government or a corporation, unlike the other assets mentioned here. Its value is solely dictated by what traders are willing to pay for it. Cryptocurrency is a reasonable investment for risk-takers who don't mind if their investment goes to zero in exchange for the possibility of much higher returns. It's not a decent investment for risk-averse investors or those looking for a safe haven. What do you think about this video? Do let us know down in the comment section below. If you enjoyed this video and want to hear from us again, be sure to hit that subscribe button before you go.